Hi, this is John from iwillteachyoutosucceed.com. Today we're going to walk you through the PLAN100X visual business planning tool designed for small to medium enterprises. Really exciting tool, first of its kind in the market, highly visual graphical outputs for you as an entrepreneur. It's got all the normal financial forms and documents, really impressive 30-page long business plan, which really requires minimal input from your side as user. So let's get started. Before I start, let me just say to you that what every entrepreneur wants to know is, can my idea make money? And very importantly, before you start wasting time and pouring resources into an idea, which we all have, can this idea make money? The second thing an entrepreneur wants to know is, what sales will I need to break even? So I've got this idea, I've got a feeling for what the costs are, what sales will I need to achieve over a period, the first year of business, the next few years of business, in order to break even, to be able to cover my overheads. The next thing is, what startup capital will I need to get my business going? Also a very important question. The fourth one is, will I have any cash flow holes? Will I have periods in my business where I'm out of money, and I need funding? Finally, and this is where PLAN100X comes into play, is, can I get a business plan that is easy to complete and I don't have to go searching all over the internet to try and find bits and pieces of a business plan and piece it together? Is there this one plan? And the answer is yes. So there is a single document and no spreadsheet skills are needed. And it's a highly professional output. In total, with all the graphical outputs, this visual output, a total of 30 pages of business plan, very professional, and something you can keep updating every year to keep it current. Right, so let me go on to telling you about what's in this PLAN100X toolkit. The first thing is, you get the business planning tool, the PLAN100X SME, small to medium enterprise visual business planning tool. The second thing, there's an end user license agreement. Please respect this. This license agreement says it is for your use. You can obviously use it on multiple businesses, but it's for your use. So we don't want you passing this around. When you download this tool and you open and accept this end user license agreement, it is a single user license agreement. Then there's a very powerful user guide for the PLAN100X. The user guide takes you right through every step of the way. I'll show you when we get into the tool how the help works in the tool. Outside of that, there's a PDF document that takes you through every step of the business plan. Microsoft Excel guide. So very important for you to know that this business planning tool is built on the Microsoft Excel platform, the spreadsheet platform, and it's quite a complicated spreadsheet. There's lots of formatting, and if you were to take it into another spreadsheet platform application, it would simply not work. So we say to you that before you make a decision to download this tool and buy it, it's on our website. Hopefully you've read about that. You do need Microsoft Excel to run it. So what we've done is, we've shown on this guide that comes in the toolkit how you can get a free version if you don't have Microsoft Excel. It's a 30-day free guide, and then it can be extended to for a further 30 days. There's also an online version. There's an online version that you can use. However, we don't recommend it, where it doesn't always come out the way it should. So we recommend using the downloadable application that will sit on your laptop or your computer, the Microsoft Excel application. So have a look at that. What I put to you is that if you're going to be using this business plan on an ongoing basis, updating it, then my advice to you is, outlay the money, get Microsoft Excel, and make sure that you have the proper application to run this very powerful PLAN100X business planning tool. So the first thing that I can tell you about PLAN100X SME visual business planning tool is that it's a comprehensive business plan. The inputs: company and industry, marketing, products and services. There's a very nice costing module where you can cost your product or service, operations, sales and distribution, a SWOT analysis, all the financial reports, goals and objectives, and any appendices. So anything that might be outside of this business plan, there shouldn't be a whole lot. But if you wanted to append onto this business plan anything outside of it, there's a place to do that. In terms of the financial statements, this is what you'll get: 12-month and 4-year profit and loss. You'll get a 12-month cash flow statement, a capital funding plan, tax liabilities table. This is something new which we're really proud of. You won't see this anywhere else in terms of normal financial statements, but what we've produced for you with this, and I'll show it to you just now in the tool, is a tax liabilities table. No more surprises for the entrepreneur who starts a business and suddenly gets to tax day to pay taxes, be it your corporate tax or your monthly value-added tax. No surprises in terms of what is due and payable. Financial analysis, a summary of your financial statements, an overview, and sort of an opinion of these various financial statements. And then finally, in terms of the financial statements, a balance sheet and your financial ratios. If you were to take this business plan along to any investor or bank, they would want to see that. It's probably not something you're going to do right up front. It's probably going to need some assistance in terms of a qualified financial person, but it does have that facility. It's got a balance sheet that's got a time for now and a time in the future, normally in a year's time. Graphical outputs, very exciting. This is where we differentiate ourselves from all the other business plans that are out there. We've got this highly visual component. Firstly, there's a 4-year view. We love this. It gives you a 1-page. You can see your entire business, how it's going to operate, the profits you're going to make on a single page where you can see all 4 years. There's revenue, there's profit and loss, there's cash flow, and so much more. So I'm going to get straight into the tool. So let me go there and take you through it. Right, so here we are in the PLAN100X Visual Business Planning tool. And before we start, I just want to point out a few things to you. The first is that we're busy working on the 5-product version here. There is a 10-product version as well. I also want to point out the fact that we have very good support. If you are in any need of help, you contact our support desk and there will be someone there to support you. You can also log a ticket and we will come back to you formally on email to be able to ensure that you get the right level of support. Before I go any further, I want to take you out of this and into the help file that came in the toolkit. So when you opened your zip file, you would have seen a user guide, and that's where I want to take you to now. Let's have a look. So here we are in the PLAN100X user guide. It's comprehensive. It is, last time we looked, it is 60 pages long and covers every step of the way in terms of what you need to know. I'm going to go now to, let's have a look, page 16, I think is where everything's really start. And yeah, you can just have a look here and see the type of information that's available to you. Every single input needed there's an explanation. So there should be no reason for you to get stuck. Refer to the user guide, and obviously there's some research needed. If you're going to go into all the content that's needed for the detailed business plan, you are going to have to do some research. You're going to have to build the content, but there's very, very good guidance here on exactly what you should be doing. With that said, I'm going to get back into the business plan. Here we are again, and important to note on the right hand side there's a disclaimer. This disclaimer is very important. You know, we've done everything we can to make sure that this business plan works perfectly well, and we can say we're 99.999% sure that all the formulas work well. And what's important is that you do have your financial accountant, bookkeeper, whoever, have a glance over this business plan before you start using the information presented. So that disclaimer is for that purpose. Also important to note is that we have a quick start. Now there is a separate YouTube video for this. If you want to look at the quick start, look it up. These are all the inputs in this pink color on the right hand side. So the quick start is really for someone who doesn't want to go and have to input all this content, who really just wants to check if an idea is financially viable. And in that case, you'd put in your product costing, you'd put in your sales projection for the year, and you'd put in some overheads. And what that would do is give you a 12-month and 4-year profit and loss, and it would give you a cash flow statement. Very, very important. So that's what the quick start guide is. Today we're going to step through everything, and this is a pre-populated business plan, it would take so much time for us to go through and really type everything out. So I'm going to talk you through it. As I said earlier, if you need help on what to fill in, how to fill it in, go to the user guide. It'll give you all the information needed. This is where the inputs start. And before we start the inputs, let me just take you above this. Above this is the executive summary. Now, the executive summary is something which often is a little bit of an extra burden at the end of doing your business plan in terms of having to extract the information needed to put into an executive summary. What Plan100X does, it does it for you. So there's no extra work needed to go and plow through your business plan to try and work out what you need to put in an executive summary. Everything is here. You can see beautifully laid out. Important to note that on the right-hand side of where you see my cursor right now, this doesn't print out. So everything you see on the right does not print out. Everything on the left does. The online help, also good to know, is this yellow tab here. Online help is the second tab. There you can see everything you need to know from number 1 downwards. In terms of 1, you can see it here, going down 2, 3, 4. Every step of the way there is within tool help, I should say, in tool help that will help you along the way. So we're going to come back at the end and just close off by having another look at this executive summary. But you can see that this is sitting at version 1.7. What does 1.7 mean? It means that it's really our first business plan, year 1. So that is number 1, and then we've had 7 iterations, 1.7. This version on the left hand side is the version number of the Plan100X tool itself. Starting off, we're going to put the financial year, and there it's just a simple input. We're going to come over and put the version number in. This will default to 1 as you get the tool, and then we put in the business name. You'll put your business name in there, and you'll put this financial year start. What month is your financial year starting in? So every table, every graphical output will align with this month. Very important to get that right. A brief description of your business, and then we're going to go through this quite quickly. All the information needed in terms of your business. So the industry you're in, industry description, company strengths, mission statement, the shareholders. So we've called this fellow David Blake. He's a 100% shareholder, and he is the founder, CEO, owner. Then we move down to some long-term goals. We put those in here with dates. Then we go down to any legal considerations needed, the type of ownership of your business, and then importantly, premises required for administration, sales, manufacturing, storage. If you need these, you type in, it's a selection, yes or no. You can see we've just put some addresses in here just for purposes of this example. Next, moving down, is the PESTEL Analysis. The PESTEL Analysis is really, really important. It is quite a lot of work, but it gives you a really good view in terms of political, economic, social, technological, environmental, legal factors. Now, this does need some work. If you look at the right here, there's very good advice on what to fill in here. But I would say take the time and do this PESTEL analysis. It will give you a really good understanding of the marketplace, along with political, economic, social, technological, environmental, and legal factors. We move down to products and services, and we do an overview of our products and services, any unique selling proposition points that we have, and then pain points addressed. Important to be able to know what pain points you are addressing. What market do you have? Are you servicing, so local, national, or global? And then we go down to actually naming our products or services. So that will be the product name. And importantly here, as you type this in here, it populates throughout the whole business plan. You don't have to retype anything in. Everything you type in here gets populated through the entire business plan. So you will type for each of your 5 products. If you're using the 10 version business plan, you type in for all 10 here. And then you type in features, benefits, and differentiators for all of these 5 products. On the right-hand side, you can see here 2 columns of pricing. What Plan100X allows for is 2 price points. So price point 1 would be where you're selling this product in terms of, it could be a wholesale price point, and price point 2 could be a retail price point. So we've only got price point 1 in at the moment here, and let me show you where that comes from. You can't update this. The gray cells, what I didn't mention, and let me just go right to the top again. There's a notice here on the right at the top by the executive summary, only input gray cells. So the spreadsheet's locked down. You can't get into all the other cells when using Microsoft Excel. And the reason for that is that there's a lot happening in the background. There's lots of calculations happening, and we don't really want you going and fiddling in those cells because it will destroy the integrity of this tool. All right, so coming back down again to where we were looking at the product and service costing. I'm going to show you where these cell prices come from, and there we go down to this module here, so product and service costing. There you can see these product names have come down automatically, and what you have here is the opportunity to put in 5 different product costs that make up this product. At this point, let me say that if you go right to the end of these tabs, there is a detailed costing sheet. Let me click on this now and show you. This is a detailed costing sheet, and this aligns with those 5 product costs at this level. So if you had a very, very detailed product costing where you needed to input more items than 5, you would come to this detailed product costing sheet. Remember, this is based on a spreadsheet. It's not a database. So you would need to either duplicate, move or copy. You'd copy this multiple times and name it for every product and then save it, or you'd simply print this to PDF, and there you've got a hard copy or digital copy of this detailed costing sheet. But the point is that these are the 5 costs that you would bring back into your product costing on the plan. So getting back to this plan, there you can see we put costs in here of 100, 125, 150, and 0. The batch size. What does the batch size mean? Well, if you were making a product, let's just say it was a sauce or something along those lines, and you were making it in a big pot, and then out of that pot you'd get, let's say, 30 bottles. Your batch size down here would be 30, and then all those costs would be split up between 30 bottles. Right now we're costing for 1, and that's why the batch size remains 1. We have a product cost of 375, which is the sum of all those. And then what we do is we apply a markup. That markup takes us to this sell price of 563. Let's go back up top and have a look. There it sits, 563. Now, the same thing applies for all 5 of the products. You have to go through all 5 products, input these product costs to generate your sell price. On the left-hand side, you can see what's happening here. We're getting we've put in a markup on the left to get to price point 2. So price point 2 sitting at the top here at 525. I'll just left that in as an example. If we had to put that in at 0, which is the default, then that price point would disappear. What I wanted to show you here was how these input sell prices work. These are calculated sell prices. However, if you choose that 563 is not the price that you want to sell at, you can input another number. Let's say you chose 599. Now there's a warning that comes up letting you know that you have input a sell price. It's not the costed sell price. And what will happen then is this price will be used in place of the 563. Your gross margin gets impacted by this sell price, no longer the 563. You can do the same on price point 2. So let's just say on price point 2 we decided on 549. But right now for this example we're just going to leave these at 0. Hopefully there's no questions around product and service costing. You can make any notes you need here. The next table down is product and service development or cyclical costs. And what you're going to do here is put in throughout the year and the 3 years that follow. Note that the 3 years that follow we're doing on a quarterly basis. We're forecasting and projecting over 4 total years. Year 1 is in months, and years 2, 3, and 4 in quarters. So what we do here is we put in either $500 or $1,000, because what we're going to do is put in increments of 500. So in March, we're going to spend $500 and nothing more. For product 2, we're going to spend $1,000 in March, and then in November another 1,000, etc. So that's how this works. We're going to put in a unit cost, normally $500 or $1,000 or $2,000, and these are multiples of these costs throughout the 4 years. We're going to go through the marketing plan. We're not going to go through it now. There's lots of help on the marketing plan. Very, very important to spend time on this. We're going to list our top competitors, and we're going to do a competitor analysis. So the first thing we do with competitor analysis is we say, in terms of product, how important is it to our customers? We've put this in as 4. And then what we're going to do, after we've said how important it is, we're going to rate ourselves, how we do on product, and we're going to do the same for competitor 1 and competitor 2. And what this does is it comes out at the bottom and it gives us a competitive rating. Here we are rating Eco Homestyle as 181, and ABC Stores is 140, and XYZ is 129. It's important to note that price, good on price is excellent, bad on price is poor or terrible. Moving down, just to list some competitive advantages, disadvantages, onto the social media plan. So very important in today's world, how we're going to be handling social media. We're going to put in our social media plan. Again, very good advice and tips on how to do that. There is your social media URLs placed for that. And then we're going to put in our marketing and website budgets. All pre-done. As I said, we've pre-populated this to save time, but this shows you what you can do here. We have just put in at the top 3 items: social media advertising, and promotional material. You can input all of these and include them across. So your marketing budget right now sitting at 4150. I'll show you at the bottom where that comes into play. On the website budget, the same thing happens here. We've input 1, 2, 3, 4, 5, 6 different levels of website budgeting. You can input the rest. At this point, we have a total of 3890. Operations plan, how we're going to staff our business, and here we have place to input for positions and roles in the company, the level, is it a manager, is it a worker, is it the owner, and what the salary level is, and we put the head count in. So you can see what's happening here. We have sales staff starting off with 1, growing to 2 across the year, and at the bottom here it gives you your total headcount across the year, starting with 2 and going up to 5. Important is to put in the staff benefits. So these are the company contributions to staff benefits, where the company pays some of the staff's medical aid or pension. That's what we're seeing here. So input that percentage. You might have to talk to your accountant to get that number, but where your business is paying over a portion of that staff member's medical aid or pension or something like that, that is what that is, because that's going to show as a cost. Right, so we have production plan, we have inventory plan, we have the operations location, and we have shipping costs. So shipping costs we've left in at 3.5%. We assume we've got a physical product that we're shipping. That's not a bad number. You'd normally find 3.5%. Somewhere between 3 and 4, maybe even 5% in some cases would be your shipping as a percentage of sales revenue. Right, down to the distribution plan, sales and distribution plan. So importantly here, we have the forecast. So we're going to put in the forecast here. I've used for product 1, price point 1, 100, price point 250, and you can see we only had two price points on the first product, and the rest we've only got 1 price point. So what we've done is we've projected the sales across the year. We've got a straight line starting at 100, ending at 100. However, up top here, we've put some seasonality, and we've said in November, December, we expect high sales. It's high season, but in January it's going to drop off. It's going to be a very slow month. We're down to 90% of our normal sales. So this seasonality applies to all forecasts. What you can do is put in a reduction for worst case scenario at the end here. So what that means is, at this point you can see 75, meaning we've dropped down 25% lower than what these. So this would be 75, not 100 in the sales revenue forecast. We're very sure about this number. We've left it at 100%. So that's what we're doing here. We're reducing where we're not confident of making this full sales forecast to make sure that we still have profits available to survive. The worst thing an entrepreneur can do is state a very bullish sales forecast, and then you don't make it, and you start getting into a negative cash flow position and go out of business. So that's what that does. And so what's happening here is these forecasts are being translated using the selling price into a sales revenue forecast. Again, you can see all the gray numbers at the top here we can input. However, below here we cannot access these numbers. This is for sales commission, and you can see on price point 1 we have no commission payable. On price point 2, we've got a salesperson, let's say, that we've given a target to sell 50, and we're going to be paying them 20% commission. And what happens here is we're saying how many days after the sales month will that person be paid. Normally it's the next month, so we leave that at 30 days. At this point, I want to draw your attention to this year 1 margins on the right-hand side. We've brought this up from the profit and loss statement below to make it easier for you to see what will happen. So if you were in a negative net margin position and you were upping the sales numbers or fiddling around with the sales numbers, very nice for you to have this visibility at this point where you can see exactly what's happening. I want you to see what happens as I increase a number here. So let's take this 100, and I'm going to just use a number of 1,000. And just watch what happens to these margins here, right? So the gross margin stays the same, 30%, because our cost of sale hasn't changed as a percentage of the sell price, but the net margin has increased. Take that back to 100, and you'll see it drop down again. Right? Not a whole lot, but it does allow you to fiddle with these numbers. Let's just change one to make it really a big difference, 10,000, and you can see what happens. It starts to boost our net margin tremendously, right? So that's why we have this year 1 margins block on the right hand side, so you can see exactly what's happening. As we move down, we get into the graphical representation of sales. So this is year 1, remember, these are our 5 products listed at the bottom, and you can see exactly what the contribution of each product is. The early ocean breakfast suite is the one that's making the most sales and doing the most business for us, and then we have the cumulative sales curve below that, in the graph below that. So then we go on to the sales plan. How are we going to make sales? What are we going to do? That is where we outline here. Again, go to the help file, the user guide, and we'll show you exactly what to do. What are our distribution channels? What's our credit policy? I'm going to talk about credit policy a bit later when we get down to cash flow. It's very, very important to have that really, really sorted out, because credit can help your business, or it can devastate your cash flow if given at the wrong time and to the wrong percentage of your sales. The next thing we're looking at is a SWOT analysis. So this is the SWOT analysis. If you haven't done one before, very important exercise. Again, very good help in the user guide in terms of what you should be doing here. But it's listing your company's strengths, weaknesses, opportunities, and threats. And what we do here is go through each of these, and then below, in terms of the SWOT actions, we're calling out weakness 2. What are we going to be doing to counter weakness 2? Threat 1, what are we going to be doing to counter threat 1? Opportunity 1, what are we going to do to capitalize on opportunity 1? That's what we do in this section here. Very important. Right, going on to the financial plan, which is a very, very important part of the business. So here we are in the financial plan. The financial plan is largely done for you in terms of the reporting. There's a bit of input to do. Let's go through it and show you. So the first thing we're going to do is input startup costs. So startup costs, we've put in 6 different categories of startup costs. You can change these if you want. These are input fields. And so typically what you'd have in terms of improvements to the property, if you were leasing it, was, painting, cleaning of carpets, you'd buy some furniture, desks and chairs, etc. So in terms of startup, there might be some salaries, there could be some moving costs, and obviously always good to have a contingency. So this total startup cost at the moment is 46,000, and we have an option to include this in the cash flow in month 1. We've said that month 1 is March, you can see it here, and we're going to include that. The next thing we're going to do is tell PLAN100X what months we are paying tax in. Very new feature this to PLAN100X, where we can tell Plan 100X which months. So often in countries you don't pay VAT every month. It's more often than not every second month. For this exercise, I've said every third month. It's not to say you don't pay tax in May and June. Tax is liable, but you only physically pay it over every third month potentially. You need to check with your tax authority what is the situation with paying over VAT, and then you would have to input here exactly which months those are. Again, we started in the month of March, as you can see, right? Then you go on to inputting what your actual sales tax is in your country. So in this case, I've left it at 15%. We also have allowed for two other sales taxes. This doesn't apply in all countries, but in some countries, let me give you one example. In some countries, you have what they call withholdings tax. So if you offer a consulting service into a country where you don't, where they're not able to take tax off you in terms of normal VAT or sales tax, and they're not able to tax you in terms of pay as you earn type tax for an individual, they will have a withholdings tax. It can be up to 12%, which you'd have to put in here if that was the kind of service you're offering, and you'd need to budget for paying that tax at this level. So that is sitting at 0 for this example. The next thing we do is we're going to tell Plan 100X if we're paying a staff bonus. You're probably not going to be wanting to pay a staff bonus as a startup. We've said yes for this example. We've said it is 20% of the gross monthly salary amount. In cases it could be 100%. Some companies pay a 13th check, that would be 100%. And then what month are you paying it in? You typically choose a month that is good for your cash flow. We've just chosen the month of May. Right, so going down to the first of the financial statements, which is the profit and loss statement. This is it here. You can see what's happening. A lot of this, in terms of your inputs, is done for you. All your sales are in. Your cost of sales are in terms of the product costings which you did. These are your shipping costs that have come down. Remember we said 3.5% of the selling price. And here's your gross margin sitting at 30.2%. Not bad for a company. And then what happens below here is we start to put in, here are your inputs again, these gray cells. We're starting to input our other costs, our overheads. So remember, there's two distinct types of costs. There's the cost of sales, the cost to produce your products, and there's the indirect costs which are sitting here, which are the cost to run your business, your overheads. And we've obviously just put some in here. We've got a whole lot of examples in. You can change these. These are inputable, changeable descriptions, and the amounts as well. You can go through and obviously change these too. Again, what's happening here is we've put this in here. Obviously, you can see these numbers, 30.2% is aligning with that. The 24% is aligning here. But I just want to show you quickly, if we had to add in an indirect cost here, let me just show you what happens. If I add 10,000 in here, I want you to see what happens to the net margin. It goes down. And this is why this is so powerful. If I add a 20,000 more, you can see it drops further. And so at this point, you can really start to manipulate numbers, make sure you make enough profit, cut your costs as needed. So that is the indirect costs now added. Below here, you can see our net margins all in the positive, looking really good. And what's happened here is we've got a provision for tax for year one based on our tax rate, which we input right up the top, company tax. The tax provision for year one is $521,271, which is really great, a good number. If we're making profits, we need to be paying our taxes. And importantly, now we move on to the break-even sales. So break-even sales, for those that might be a new term for you, is what sales do we need to make in order to cover our overheads. And the number we have to make here to cover our overheads is $128,671. And you can see we over that. Obviously, this is a bit of a fictitious plan, but we over that by $578,860 in month one. And there you can see it. So you can see our indirect costs are very, very low in comparison to our sales and our cost of sales. So this is not a very accurate example of a business, but at least it shows you how it's working. So very importantly, to make sure this is all in the green, so that what we're projecting is covering our costs of running the business. So we have any balance of expenses that goes into here, this line, balance of expenses, and then we'll offer any commentary about this year 1 profit and loss. Now what happens is we go down to the 4-year profit and loss projection. When we say 4-year, it's year 1 above and then 2, 3, and 4. So we take these last 3 months, the last quarter of year 1, and we average all these numbers, all the values in the last quarter, and use them to project into year 2, quarter 1. So all we're doing here, the only inputs needed is this. And what that means is our sales are increasing by 5% in quarter 1. We've kept our cost of sales tracking with that at 5%. However, we've only increased our indirect expenses at 2%. We do the same for each quarter. So you need to have a good look at this. Maybe you're going to start bringing it down a bit, 4, 4, and 2, maybe 3.5, 3.5, 2, as you go forward into year 4. And again, if you look at the right-hand side, what's happening is you can see exactly the profits you're making in all of those years. So let's just look, for example, if we had to increase our quarter 4 here, let's just put in 10%. I want you to watch what's going to happen over here. But we're going to increase that to 10%. And you can see immediately it impacts your gross and your net margin in year 4. I'll take that back to 5%. But what this is doing now is it's taking you through all the sales, the cost of sales, your shipping costs, your gross margin, still at 30.2% because we've kept this 5 and 5 the same. So that's going to be a consistent gross margin. And then what it's done is it's brought through, there's your salary and payroll by quarter, there's your staff bonus. Remember, we put a staff bonus in, I think it was the month of May, March, April, May. Yes, it was May. So you see that in quarter 1 for the 3 years, and then these are all your expenses coming through. Remember, we said we got some sales commission. There's your sales commission line through there. That's how powerful this tool is. And looking very nice, our net margin, 23%, 24.1, 24.7 net margin, looking really healthy, and tax provision for year 2, 3, and 4 sitting there. Again, for the years 2, 3, and 4, we've got our break-even sales by quarter, and there you can see looking really healthy, all in the green, looking fantastic. At the top of this is just a summary of the total sales and the year-on-year growth. So this is 14% up on the previous year. This is 22% up. This is 22% up. So that's how it works. Now this tax liability, you heard me talk about this earlier. Very, very important table. It's very colorful, but it serves a purpose. So this is how much tax we will be paying over in terms of our day-to-day, month-by-month operations. We have 2 kinds of taxes in terms of sales, the output and input. Our output tax for sales is really our that 15% we had. It's going to be different in your country possibly. That's the 15% of the sales. Remember, as a company responsible for charging sales tax and paying sales tax on our purchases, it is our duty to pay over that difference to the receiver of revenue, or whatever the revenue authority is called in your country. But that is our job as an organization, a business, an enterprise. We are an agent for the taxman. So it's very important for us to keep stock of this, to keep track of it, and you can see what's happening with our output tax. We've got 2 input taxes. One is our tax on the cost of sales, and the other is the cost on our tax on our indirect costs, giving us a total VAT per month. Then what happens, remember we had those 2 other taxes. We chose to make them 0, so they're sitting at 0, giving us a total tax per month for year 1 at that line. Now the same thing happens for year 2, 3, and 4, and then at the bottom here we have total tax payments. And remember we said we're going to pay in April, in June, and October, and January, and that's exactly what you're seeing. So this is the tax that you'd pay in the months we said you'd pay it. So what it does is it adds up the tax for March and April, pays it all in April, adds up the tax for May, June, and July, and pays it in June. In July, I beg your pardon, and then adds tax for August, September, October, pays it in October. Right, so moving down to our cash flow statement. This is probably one of the most important documents in the entire business plan. It lets you know whether you're going to be making money and how much. We've started off here, I've just put in 20,000 dollars in this case as a startup funding from the founder. And what we've done is we've got a very healthy cash flow. It's starting off in the green, 241,000 here, going all the way up to 1.984 million within a year. So in this case, a very, very profitable business, making a lot of money. Okay, so what do we have here? We have cash sales, and I need to draw to your attention the fact that these cash sales do not have a commensurate cost against them. So the rest of the sales you put in has got a cost of sales based on your product costing. In this case, just be very aware that there's no costs that are going to be put in against this. If you are going to put any cash sales in at this level, you're going to have to almost go up and add some, or put in some other costs at the bottom here in terms of balancing out with these cash sales. Right, so the next input here, these gray cells on the side, is that we've said that 70% of our sales we are not giving any terms, and that's this line you see here, and 20% we're giving 30-day terms to, and that's why the cell is 0, because we're not collecting for these sales in that month, and then 10% is going into 60 days, and that's why in the months of March and April you see no collections. So what does that mean? Look how important it is. Let's just say that we gave 90 days. I'm going to just give you an example. 90-day terms on 70% of our sales. Look what it does to our cash flow. It really takes it the wrong way. So it's very, very important for us to keep control of collections and manage the terms. We don't want to be giving out terms to people that are buying from us. The same thing applies in terms of cash paid out. Obviously, this works the opposite way around. So here we've said 80% of our purchases in terms of our cost of sales will be payable immediately. You can see again what this does. If we had to get terms from a supplier, look what happens up top here in the green line when I put in 90 days. Boom, it goes right up. So that's what happens. It's very, very powerful tool, this, in terms of allowing you to see what happens to your cash flow when you give terms, either in terms of sales or in terms of purchases. Right, and then going down, these are all the amounts that have come down from your profit and loss. Remember, this is cash flow just for year one. Yellow is year one, starting in the month of March. And then all we're doing here is we're putting in any terms. So, you just have to go down here. And if there are terms on any of these purchases, you would put it in here. Let me just say rental. Although rental you normally pay in advance, I'm just going to use this as an example. But we could put in 60 days, and you can see what happens. These first 2 months become 0. We're going to put that back to 0 for now. Right, so after you've done your cash flow, there your startup cost sitting at the bottom. Remember, we said we're going to add our startup costs of 46,000 in the first month, which was the month of March. We add a commentary, and now we get on to the funding capital plan. So the funding capital plan is very important because it allows you to input any capital you might need to plug any holes in the business. We don't really need capital. I've just added these in to show you how it works. And if you scroll back up to the cash flow, you can see at this level, there's the funding for year one in March and April. If we had to take that funding out, it would bring this down to 41,000, I beg your pardon, and similarly down here, this would drop right down. So that's the way the funding works. It'd either be a bank or an investor or someone that wants to put money into your business. This is the financial analysis going down now for the first year. And what this does really is it summarizes all of our financial information from sales units all the way through to revenue, to cost of sales, gross margin, indirect costs, net margin, break-even analysis, monthly tax, funding, and then total cash available. So remember, we had 1.984 million of cash. That's obviously the bottom line. It is important yet to notice this light gray texture that says that there might be a disconnect, not a direct correlation between sales units and sales revenue. The reason for that, remember, we put in some seasonality and we put in a worst case scenario. So the sales units will be as projected, but the sales revenue would take into account seasonality and worst case scenario. Very important to know that. Then we have some commentary, so you might need to get a financial person to give you some advice and some input on that. And then we get down to as you heard me talk about earlier, the balance sheet. The balance sheet, we have two dates. Normally it would be the time now when you're starting your business, and in a year's time. That would typically be the time frame. How are you projecting your balance sheet to change over time? This balance sheet is something that most entrepreneurs would not be able to complete without some help from a financial expert. Out of this balance sheet comes financial ratios, which are very important, and then going down there's financial assumptions, and we go down to the business plan appendices, the first of which is short-term goals and objectives. So we have up to 50, I think it's up to 50 different short-term goals and objectives that we can add here. We just put in 3 to give an example. There's different categories you can put in, and then what that short-term goal, who's responsible for it, and the date by which it's supposed to be done. A reminder on the side here to consider SWOT actions. Remember, we did the SWOT analysis at the top. It might be a good thing to bring a few of those actions down and put them in at this level at Appendix A. Right at the bottom, which doesn't print out, is really business plan revision notes. Now, you know, we had this at 1.7, so maybe we should just add that in there at 1.7, but normally it started off at 1, and then as you go through, you make the notes as to how you've revised this business plan as you've worked it. Right, so moving back to the top again to the executive summary. Right at the top, you can see what's happening here is that everything's pulled through, nothing to do, absolutely nothing. Everything is here. Again, the same light gray warning is here about the correlation between sales units and revenue. There is a difference in terms of the worst case scenario and the seasonality. At that is, so there's your financial analysis for year 1, years 2, 3, and 4, and then your financial ratios, and that's how it will print out. So this gets to look really nice. Let me just show you how it looks in terms of how it prints out. So there you have it. There's your page 1. It's 17 pages long. This is your executive summary. It looks really professional, and then we can go on to the different elements of the business plan. We're not going to step through everything right now, but it looks really professional, looks really good, something you could really take to your bank and raise capital with. Right, so before we finish up, I want to show you a few of the visual graphical outputs. The first one is revenue, and there you have it. Really, really nice looking graph for you. Shows you the sales revenue forecast versus the actual. So what we're allowing you to do here, remember we said gray is input. You can come through here and put your actual sales in, and what this does is it shows you sales forecast versus actual sales and the variance. And you can see what's happening. There's a year-to-date variance as well. So you're currently 5.8 at the month of July, 5.8% over your target, which is really good going. Then we go on to cash flow, and again, really good. So cash in is the blue, cash out is the green, and the red is the variance, and you can see what's happening here. Really positive cash flow curve. This is where this would turn red if you were underwater and running out of money. Next is your funding. Remember we said we're putting in funding in March and April, as well as in the years 2, 3, and 4. Then we have got the profit and loss, so really nice visual representation of profit and loss for year 1. We have profit and loss for years 2, 3, and 4 by quarter. Really nice visual depiction of that. This is the really exciting view that we have, which is the 4-year view. It gives you a 4-year view in terms of your sales, your cost of sales, which is in green. This is your gross margin. These are your indirect costs. As I said earlier, probably a little bit light for a business like this. Then we have net margin, and then importantly here as well is the tax, which we're paying out on an annual basis. So there you can see the tax, 375 for. So very nice visual depiction, graphical depiction, as well as the tabulation. In one view, one page, you can see exactly what your business looks like. Moving on to cost of sales, that's what cost of sales looks like. And again here, we can put the actuals in. So that was the budgeted cost of sales. These are our actuals. And you can see what's happening here. We are slightly ahead of our cost of sales. We improved and then getting worse, getting better again. And currently we're sitting minus 2.7% less or over target, I should say, over the sales budget, cost of sales budget. Then we move on to our indirect costs. Again, we can input our indirect costs on a monthly basis, and you can see what's happening here. We 17.5% worse off than what we had budgeted. We would need to go and understand what's causing that. So then out of that comes our gross margin, and looking really, really healthy. We're currently at 13.1% up on the year, and net margin at 12.1% overall. That's over what we had forecasted, remember, over what we had forecasted. It's not the actual net margin, it's the percentage to which we are over what we had forecasted. So that's it. These are the visual outputs that you get from the PLAN100X tool. Really, really exciting, and we believe it allows you to see your business in a whole new way. And so what you do is you would print out the plan, and you'd go through and print out each of these graphical outputs. And there's some really good tools out there to combine PDFs. There's one called PDF Combine, I think. And what you do is you just put them all together, add it into a single document, and very presentable to take to a bank. So in total, it's about 30 pages that would comprise your business plan. You can see not a whole lot of input. There's a degree of input required in terms of the content, the marketing plan, operations plans, and stuff like that. But it's very simple to input. You only need typing skills really to use this plan, and hopefully you have this plan, this guide, this video open when you're doing your business plan for your business, and you can just step through it as you go, and it'll take you along every step of the way. So that's all we have for you today. I hope you enjoyed it. I'm going to just go back to the presentation just to close off. Thank you. So I hope you enjoyed that. I hope you've got a good understanding of how the PLAN100X visual business planning tool works. And thank you for taking the time to go through it with me. Finally, I want to say to you, why not subscribe to Team Success 100X? What this is we'll be sending out weekly newsletters on these different areas: your life, your career, your business, your online business, and your wealth. So you can select all or only select one or two, and you'll only receive information that you've asked for. Very importantly, here is the URL to go along. Join Success 100X team, sign up for it, and I look forward to seeing you on the inside. Thank you.